Good morning, everyone. Welcome to the market opening bell for Monday, 24th November 2025, your 10-minute guide to the stock market. Hong Kong stocks spent last week sliding lower. By Friday, the Hang Seng Index had dropped to an intraday low of 25,178 before closing at 25,220, down 616 points or 2.4% on the day. The H-share index slipped below the 9,000 mark and finished at 8,919, also down 2.4%. The Hang Seng Tech Index suffered the heaviest loss, closing at 5,395 after shedding 179 points or 3.2%. Against the tide, Southbound Stock Connect Money remained the buyer, pouring a net 105 million Hong Kong dollars into Hong Kong stocks. Tencent led the inflows with 1.736 billion Hong Kong dollars, followed by Xiaomi with 1.268 billion and Alibaba with 1.158 billion. Kuaishou, Meituan, and Xpeng also saw decent buying. On the sell side, the tracker fund saw a huge 5.143 billion outflow. Interestingly, southbound funds have now bought Alibaba for 7 straight days, totaling 13.321 billion Hong Kong dollars, and Xpeng for 4 consecutive days, totaling 1.871 billion. For the full week, the Hang Seng Index lost 1,352 points or 5.1%. The H-share index fell the same percentage, while the tech index plunged 7.2%, marking its 4th straight weekly decline. From a technical perspective, the Hang Seng managed to hold the 17 October low of 25,145. Today, it is expected to follow the strong U.S. rebound. Hong Kong ADRs are pointing to an opening around 25,586, roughly 366 points higher. That would allow the index to retest the 100-day moving average near 25,640 and possibly fill Friday's 209-point downside gap between 25,483 and 25,692. Over on the mainland, the 3 major A-share indexes opened between 0.9% and 2.1% lower on Friday and never recovered. The Shanghai Composite lost the 3,900 level right at the open and closed down 96 points or 2.5% at 3,834, the biggest single-day drop since the April US-China tariff shock and a new 2-month closing low. The Shenzhen Component Index fell 442 points or 3.4%, while the ChiNext Index tumbled 4%. Total two-market turnover reached 2.079 trillion yuan. For the week, Shanghai dropped 3.9%, its worst weekly performance in nearly a year. Shenzhen fell 5.1% and ChiNext shed 6.1%, all posting the second straight weekly loss. Yet the sharper the correction, the more aggressively ETF money flowed in. Last week, stock ETFs recorded net inflows of 70.1 billion yuan, including a massive 40.8 billion yuan on Friday alone. CSI 500 ETFs alone attracted over 5.7 billion yuan. ChiNext and CSI 300 ETFs each took in more than 4 billion yuan, and a long list of Star 50, Hang Seng Tech, CSI 1000 and Internet-themed ETFs all saw inflows exceeding 1 to 3 billion yuan each. The renminbi central parity rate was adjusted 30 bips stronger to 7.0875 against the dollar. On the news front, the Guangzhou Futures Exchange raised trading fees and tightened position limits on some lithium carbonate contracts, sending Ganfeng Lithium and Tianqi Lithium down 12.5% and 11.9% respectively. Meanwhile, CATL announced it plans to restart its Jianxiawo lithium mine in Yichun as early as the beginning of December. The company has already asked suppliers to prepare equipment, chemicals, and manpower, and has notified downstream refiners. Approval is still pending, but if granted, the restart of this major lepidolite mine, capable of producing over 46,000 tons of LCE per year, will add meaningful supply and is expected to push lithium prices lower while reducing battery raw material costs. Macau's 2026 budget conservatively projects gross gaming revenue of 236 billion petas, only a 3.5% increase from the revised 2025 estimate, prompting a 4 to 6% drop in the Macau casino stocks on Friday. Analysts, however, remain far more upbeat, forecasting 256 to 265 billion petacars for 2026, buoyed by major events in a firmer renminbi. In the U.S., New York Fed President Williams hinted at another rate cut this year, lifting the probability of a December cut from around 40% to 75% in the rates futures market. U.S. stocks roared higher on Friday. The VIX dropped 11.3%. The Dow finished up 493 points or 1.1% at 46,245 after being up as much as 825 points. The Nasdaq gained 0.9% and the S&P 500 rose 1%. Chinese ADRs tracked the move, with the Golden Dragon Index up 1.2%. For the week, however, major U.S. indexes still closed around 2.2 to 3% lower, their fourth consecutive weekly decline. Among individual names, Nvidia failed to hold early gains despite another stellar report and closed slightly lower. Reports suggest that with U.S.-China tensions easing, the Commerce Department is considering letting Nvidia resume sales of its H200 AI chips to China, but still under review. Oracle dropped over 5%, while Alphabet continued its strong run with a 3.5% gain, and Amazon and Apple both rose more than 1%. On the economic data front, the S&P Global U.S. Manufacturing PMI preliminary reading for November came in at 51.9, below the expected 52, signaling a slowdown in expansion momentum. However, the services sector remained relatively robust, with the services PMI preliminary reading at 55, beating expectations of 54.6 and marking a 4-month high. The University of Michigan Consumer Sentiment Index for November fell further to 51. Gold ended the week down 0.4%, oil fell more than 3% amid U.S. diplomatic efforts toward a Russia-Ukraine peace deal, and Bitcoin briefly dipped below $82,000, touching 81,111, its lowest since early April. Our stock pick today is AIA, stock code 1299. AIA delivered an outstanding performance in the third quarter of 2025, with new business value reaching a record high of $1.476 billion. On a constant exchange rate basis, this represented a 25% year-on-year increase, while on actual exchange rate basis, the growth was 27%, comfortably exceeding market expectations of $1.405 billion. Double-digit growth was achieved in 11 of the group's 18 markets, underlining AIA's continued strong expansion across Asia and the powerful momentum in its agency channel. During the quarter, the new business value margin rose to 58.2% on an actual exchange rate basis, an improvement of 6 percentage points compared with the same period last year, while annualized new premiums grew 15% to $2.55 billion. For the first 9 months of 2025, cumulative new business value reached $4.314 billion, reflecting 18% growth on a constant exchange rate basis and 19% on an actual exchange rate basis. Over the same period, the new business value margin climbed 4.6 percentage points to 57.9%, and annualized new premiums rose 11% to $7.492 billion. The agency distribution channel remained the cornerstone of the group's success, delivering 19% growth and contributing more than 70% of total new business value. Recruitment momentum stayed robust, with the number of new agents joining rising 18%, which in turn supported further expansion of the active agent force. The partnership distribution channels, comprising Hong Kong's independent financial advisor and broker networks together with the overall bank assurance business, recorded an impressive 46% increase in new business value. By market, AIA Hong Kong posted posted 40% of new business value growth, driven by strong demand from both local customers and mainland Chinese visitors. AIA China achieved 27% growth, helping lift the 9-month figure for the group by 5% year-on-year. Across the ASEAN region, new business value rose 15%, supported by double-digit advances in both agency and partnership channels. Thailand stood out with 20% growth. Singapore delivered strong gains powered by agency and partnership performance alike, with new agent recruitment up 9%. And Malaysia returned to overall growth in the third quarter, thanks to improved agency productivity and continued double-digit contribution from partnership channels. Double-digit new business value increases were also recorded in South Korea, Vietnam, and India. Demand for the group's traditional protection and unit-linked products remained very healthy in local markets, enabling new business value margins to stay in line with the level reported for the first half of the year. AIA's continued emphasis on high-quality recruitment drove increases in both new agents and agency leaders. From a technical perspective, AIA's share price has pulled back into its previous 70 to 77 Hong Kong dollars consolidation zone and is now approaching the midpoint of that range near $73.5, which also coincides closely with the 100-day moving average. This level is regarded as an attractive entry point with a price target of $80 and a stop loss set at $70. I do not hold the above stock. That wraps up today's market opening bell. See you tomorrow. Have a great trading day.